The stock market. For many, the term conjures images of flashing numbers on a screen. Montage. Diverse faces looking at stock tickers with BSE building in background, green arrows pointing up, red arrows pointing down. It seems like a world far removed from our daily lives. A complex game played by experts in sharp suits, trading fortunes with a click of a button. But in India, the stock market is much more than that. It is the pulse of the nation. It is a story of hope, ambition, and the collective dreams of over 1 billion people. It reflects our economic health. It reflects our political stability. It reflects our confidence in the future. The ups and downs of the market are not just abstract figures. They are deeply connected to the savings of a retired schoolteacher, the expansion plans of a small family business, the job prospects of a young graduate. Every day, millions of Indians participate in this grand economic drama. They are not all big-time investors or financial wizards. Many are ordinary people. They are putting aside a small part of their monthly salary. They hope to build a better future for their children, save for a daughter's wedding, or simply make their hard-earned money grow. The market provides a platform for these aspirations. It allows big companies to raise money from the public. It allows small companies to raise money from the public. This money is then used to build factories, create new products, and generate employment. The savings of individuals are channeled into the productive engine of the economy, creating a cycle of growth and prosperity that touches everyone. Think about the tea you drank this morning, or the car you drove to work, or the smartphone you are holding in your hand. Chances are, the companies that made these products are listed on the stock exchange. When you invest in their shares, you are not just buying a piece of paper. You are buying a small part of that company. You become a part owner. Their success becomes your success. This connection transforms the abstract world of finance into something tangible. It is woven into the very fabric of our modern existence and daily routines. Therefore, understanding the story of the Indian stock market is essential. It is not just a lesson in finance. It is a lesson in history, economics, and human nature. It is a story filled with incredible triumphs and devastating failures. It is a narrative of ordinary people achieving extraordinary wealth and powerful figures facing a dramatic fall from grace. This journey, from its humble beginnings to its current digital avatar, is the story of India itself. It is a story of a nation finding its feet, embracing change, and striving for its place on the world stage. It is a story that affects us all, whether we actively invest or not. The story of the Indian stock market did not begin in a gleaming glass tower. It did not start with supercomputers or high-speed internet. Its roots are far more humble. Found in the bustling streets of 19th century Bombay, imagine a time long before the BSE building became a landmark. The first stockbrokers were not sitting in air-conditioned offices. They gathered under a large banyan tree, right in front of the town hall. This was their open-air exchange. Here, amidst the chaos of a growing port city, deals were struck on the basis of trust and a simple handshake. These early pioneers were trading shares of cotton mills, which were booming due to the American Civil War. This informal gathering was the seed from which a mighty institution would grow. The number of brokers began to swell. They were a diverse group of men, driven by the scent of opportunity. The banyan tree could no longer contain their growing ambitions. They moved from one location to another, their presence marking the changing commercial landscape of the city. They were a community, bound by shared risks and the potential for immense rewards. Their meeting spot, wherever it happened to be, became the epicenter of financial activity. News, rumors, fortunes were made and lost. The need for a formal place became undeniable. As the number of brokers and the volume of trade increased, the informal system became chaotic and unreliable. A permanent address was required to bring order, credibility, a set of rules. In 1875, this need was finally met. A group of 318 brokers came together. They contributed a princely sum of 1 rupee each to establish the Native Share and Stock Brokers Association. which would later become the iconic Bombay Stock Exchange, or BSE. This was a landmark moment, not just for the brokers, but for the entire Indian economy. It was the birth of Asia's first ever stock exchange. This transition from an open-air gathering under a tree to a formal association with a physical address marked a profound shift. It signified the maturing of India's financial landscape. This institution would go on to witness India's journey through colonialism, independence, economic liberalization. The building they would eventually occupy on Dalal Street would become a symbol of India's commercial aspirations, a testament to the journey that began with a handful of dreamers under a banyan tree. The stock market is more than just an economic indicator. It is a mirror that reflects the society it serves. It captures our greatest hopes. It captures our deepest fears. When the nation is optimistic, the market soars. People invest with confidence, believing in a brighter tomorrow. Companies expand. New jobs are created. A general sense of prosperity fills the air. These bull runs are periods of great excitement and wealth creation. Stories of small investors becoming millionaires fill the newspapers. However, the mirror also shows the darker side. It reflects moments of panic, greed, despair. When fear grips the nation, the market crashes. Economic downturns, political instability, major scandals, each can trigger a wave of selling. People rush to pull their money out, often losing their life savings. These bear markets are painful reminders of risk. Dreams of quick wealth evaporate, replaced by harsh financial loss. The market that created heroes can also create victims, leaving broken fortunes and shattered confidence. The early 20th century brought new challenges and opportunities for the Indian market. The outbreak of World War I in 1914 had a profound impact. Initially, there was panic. The global financial system was thrown into chaos. The Bombay Stock Exchange had to shut down temporarily. But as the war dragged on, a different picture emerged. The war effort created a huge demand for goods. Indian factories stepped up to fill the gap left by Europe. A massive industrial boom swept the country. Wartime prosperity fueled a speculative frenzy on Dalal Street. Company profits soared. Share prices shot up. Investors, big and small, flocked to the market. Stories of quick fortunes spread like wildfire. Yet the boom was built on artificial wartime demand. When the war ended in 1918, that foundation began to crumble. The post-war period saw a brutal crash. The 4-year bubble burst spectacularly. Fortunes made overnight vanished just as fast. The crash of the early 1920s was a harsh lesson, leaving a trail of financial ruin in its wake. As India's industrial base grew, other commercial centres also felt the need for their own stock exchanges. In Ahmedabad, brokers in Ahmedabad established the Ahmedabad Share and Stock Brokers Association in 1894. Meanwhile, in the eastern part of the country, another major commercial hub was stirring. Calcutta was a centre for jute, tea and coal. In 1908, the Calcutta Stock Exchange Association was formed. The rise of these regional exchanges marked a new chapter. It was becoming a national story with multiple centres of activity. This network of exchanges created a more robust and diverse financial system. The Wall Street crash of 1929 triggered the Great Depression, and India was not immune. The Indian stock markets experienced a significant downturn, but not the complete meltdown seen in New York or London. They continued to function, providing a semblance of order amidst the global chaos. The outbreak of World War II in 1939 was quickly followed by a speculative boom. The war created massive demand for Indian goods. Alongside the economic churn of the war, the political landscape in India was undergoing a seismic shift. The movement for independence was reaching its climax. On the eve of independence in 1947, the Indian stock market stood at a crossroads, facing its greatest challenge yet: the partition of the country and the birth of a new, independent India. The joy of independence was tragically marred by the violence and chaos of partition. The country was carved in two, This cataclysmic event sent shockwaves through the nascent Indian stock market. The bull market, fueled by the war, came to a screeching halt. The economic map of the subcontinent was being redrawn overnight. Industries were cut off from their markets. The Calcutta Stock Exchange was hit particularly hard. The path India chose after independence was one of a mixed economy with a strong socialist bent. The government believed that central planning was the key to rapid industrialization. Core industries were reserved for the public sector. This policy had a profound and lasting impact on the stock market. It deliberately limited the scope and size of the private sector. The role of the private sector was curtailed. Private companies needed a license for almost everything. This license Raj stifled private enterprise and innovation. For the stock market, this meant fewer new companies coming to list their shares. The pool of investment opportunities remained stagnant. One of the most powerful instruments of this control was the Office of the Controller of Capital Issues. The CCI had the authority to decide at what price it could sell its shares. Because the issue price was artificially low, these IPOs were always massively oversubscribed. Getting an allotment of shares was like winning a lottery. Government-owned financial institutions like LIC and UTI were the dominant players. They acted as stabilizers, but also distorted free market dynamics. For the average Indian, investing in shares was not mainstream. It was considered risky and often associated with gambling. The period from the 1950s to the late 1970s can be described as the long slumber of the Indian stock market. The market was really trapped in a low-growth, low-return cycle. This long period of hibernation finally began to show signs of ending. The government began to take small, tentative steps towards economic liberalization, setting the stage for the first post-independence bull market and a dramatic reawakening of Dalal Street. The 1980s began with a new energy. A new middle class was emerging. This shift was catalyzed by a new breed of entrepreneurs, men like Dhirubhai Ambani of Reliance Industries. He held his company's annual general meetings in football stadiums, attended by thousands of small shareholders, whom he treated like co-owners. This created the first major post-independence bull run, driven not by big institutions, but by the collective power of millions of small retail investors. Companies like Reliance became cult stocks. Their share prices soared, creating immense wealth for those who had invested early. In the early 1990s, one man came to personify the soaring optimism of the stock market. His name was Harshad Mehta. To the media and the public, he was the big bull. He targeted a few specific stocks, most notably Associated Cement Companies, or ACC. The price of ACC shot up from around 200 rupees to an unbelievable 9,000 rupees. The Bombay Stock Exchange Sensitive Index, or Sensex, began a meteoric rise. This created a sense of euphoria unlike anything seen before. It seemed like a one-way street to riches. But no one was asking the most important question. Where was all this money coming from? The truth was far more sinister. He was the mastermind of a massive fraud, using the banking system's own money to create a massive bubble in the stock market. The music finally stopped on April 23, 1992. I, as a journalist for the Times of India, broke the story. The headline was simple: Harshad Mehta's rupees 500 crore hole in SBI. The bubble that had been built on a foundation of illicit money burst spectacularly. The stock market went into a freefall. Investors who had been celebrating their paper profits just days earlier were now facing catastrophic losses. The dream run was over. As investigators dug deeper, the full scale of the scam emerged. It was a systemic failure. The regulators had been caught sleeping. The scam was a wake-up call. It created an undeniable political will for deep and structural reforms. The episode became a defining moment, a watershed that would force a fundamental rethinking of how India's financial markets were regulated. The Harshad Mehta scam had exposed the clubby, opaque, and outdated nature of the Bombay Stock Exchange. In response, the government decided to create a brand new one. This vision led to the incorporation of the National Stock Exchange, or NSE, in November 1992. The core philosophy of the NSE was to break the monopoly of the brokers. The ownership and management of the exchange were kept separate from the trading members. When the NSE began its operations, in 1994, it introduced something that India had never seen before: nationwide, screen-based electronic trading. This was a complete game changer. For the first time, a broker in a small town could see the same prices and place orders at the same speed as a broker sitting in Mumbai. This democratization of access completely shattered the geographical and informational advantages. The other major problem was the cumbersome process of handling physical share certificates. To solve this, the government introduced a groundbreaking reform: the Dematerialization of Shares, or DMAT. The Depositories Act of 1996 was passed, leading to the creation of the National Securities Depository Limited, or NSDL. When you bought or sold shares, the ownership would be transferred instantly with a simple electronic debit or credit entry. There would be no more physical movement of paper. This eliminated all the risks. It made the settlement process incredibly fast, efficient, and secure. Trading volumes exploded. The internet boom of the late 1990s further accelerated this trend, with the emergence of online trading platforms. The barriers to entry that had existed for over a century were completely torn down. The digital revolution had succeeded in creating a truly national market. Just as the market was beginning to enjoy its new, clean, and technology-driven image, history repeated itself. As the new millennium dawned, India was in the grip of a global dot-com and technology boom. A new big bull emerged to ride this wave: Ketan Parekh. He focused on a select portfolio of technology, media, and telecom stocks, which came to be known as the K10 stocks. He would route money from promoters back into the stock market to ramp up the prices of their own shares. The bubble burst in early 2001. The global dot-com crash triggered a crisis of confidence. Parekh's house of cards started to collapse. The scam unraveled, and the K10 stocks came crashing down. The Ketan Parekh scam was a harsh reminder that technology alone could not eliminate greed and fraud. The aftermath led to another round of regulatory soul-searching. Rules on bank lending against shares were made stricter. The surveillance systems of the stock exchanges were upgraded. Today, the Indian stock market stands transformed. It is almost unrecognizable from the chaotic floor of the past. Millions of demat accounts have been opened. The rise of systematic investment plans, or SIPs, has made investing a regular habit for the salaried middle class. This domestic strength has reduced the market's over-reliance on foreign institutional investors, making it more stable and resilient to global shocks. The market is now deeper and more diverse, with companies from sectors like information technology, financial services, consumer goods, pharmaceuticals. This transformation was not an accident. It was built on the lessons learned from devastating scams and crises. The empowerment of SEBI as a strong and vigilant regulator has been central to this success story. India's stock market is no longer just a regional player. It has taken its place on the world stage. It is now one of the largest markets in the world by market capitalization. Looking to the future, the story of the Indian stock market is filled with immense promise. Technological innovation will continue to be a key driver of change. The next wave of growth may come from bringing the next 100 million investors into the market. However, the road ahead is not without its challenges. The ghosts of past scams serve as a constant reminder that greed and fraud are timeless threats. Regulators must remain ever vigilant. Ultimately, the stock market is a story of people. It is a story of dreams, of taking risks, and of building a better future. The banyan tree under which the first brokers gathered still stands as a silent witness to this incredible journey. From a handful of traders making deals with a handshake, the market has evolved into a digital behemoth that touches the lives of millions. The future of the Indian market will depend on its ability to uphold the trust of these millions, to continue to channel their aspirations into national growth, and to write a new chapter of shared prosperity for a new India.